Hi there, I'm Kristin Afelumo, certified divorce financial analyst, financial planner, and owner of HerPlanning. Welcome to DIY investing. It's quite possible that we've met before and you know a ton of stuff about me, but in case that's not true, here are a few fun facts, including the fact that I am a proud San Diego State alumni, go Aztecs, and mom to a 4-year-old golden doodle puppy. I'm a certified yoga teacher, and I just got married in late 2021 to this lovely gentleman, Leon. He doesn't usually make that face. Perhaps more relevant to today's conversation, here are some of my financial planning credentials. I have been in practice since January of 2014, and fun fact, HerPlanning has been completely virtual since 2018, and I have clients mostly in 3 states, Texas, California, and Washington. I'm domiciled, meaning based here in Oklahoma, and I have clients in a handful of other states too. At this point in my practice, I find that I typically work for women who are the primary income earner in their household or are making a lot of the financial decisions. In a lot of cases, they are recently divorced or recently married. That's super fun. They own a service-based business, think attorney or marketing professional, and or they've inherited some money. And so that's kind of on their mind. They want to make sure that they're being good stewards of their resources, and they've got a lot on their plate and they're looking for someone to sort of help project manage their finances and give them direction on where to go next with their money. And so I help people organize their goals, figure out what a plan is to help them work towards achieving them, consider all of what they've got going on so far, and create plans to help them make it happen. My personal mission is to help you be great where it matters without apology. And how I do that under the umbrella of HerPlanning is by clearing up financial fogginess and taking that financial confusion out of the way so that you can go be great in your business, be great in your home life, do what you want to do without having that weight on your shoulders. A few rules for today. I always say, be nice to yourself, start where you are, and be excited to take some action. If you have any questions throughout this webinar or just in general, you can always text me at 619-333-5418. There will be some free tools and resources. You can text that number to get them. Don't worry, it's coming up again. You can always email info@HerPlanning or go to my website, herplanning.com, and check out how to schedule a meeting with me. Now let's get to the good stuff. Okay, so we want to talk about investing today. I've broken up our chat into 4 categories. The first one is, are you ready? So how do you know you're even ready to get started in investing? The next, I usually say the alphabet soup of accounts, but ABCs and IRAs. So we're going to talk about all of the account types you've heard of, define them a little bit, and talk about what might be a good place for you to get started. One of the things that I'm asked about all the time is, how do you manage your risk in the market? Should I just put it all on black? We're not gambling, people. We need a specific strategy that aligns with our personal tolerance for taking risk with the stock market. And then finally, some rules that are just sort of general rules for getting started in your wealth building journey. Are you ready? And so it's not mentioned on this slide. It's on a later slide, but I'm going to recommend that if you have high interest debt, high interest to me is over 6%. Mostly I'm talking about credit cards. We abandon this webinar and we talk about debt repayment because that might be your highest return on investment. Let's assume though that you have paid off your high interest debt. You might maybe have a mortgage or student loans at pretty low rates. And you have an emergency fund established. So you've got 3 months or so of your expenses saved up. And now you have extra money and you're ready to start investing. So one of the first things I ask people often about it when they are ready to get started is, what's your goal? Are we putting money aside just because we want to out earn inflation, which today is May 20th of 2022. Inflation is really high. But in general, inflation over the average 5-10 years is usually 2.5%. So are we trying to out earn the 1% we can get in a savings account if we're lucky, or are we trying to save for retirement, and do we need to be really aggressive to get higher rates of return, 8, 9, 10%? So what is your goal for the money is a good place to start. And then how much do you have? Have you inherited money? Have you been a really great saver up to this point, and now you've got a lump sum that you're ready to start investing? Or is your plan to do what's called dollar cost averaging? Or are you just going to make a monthly contribution over time? Sometimes knowing if it's a lump sum or monthly can help narrow down what platform to use. There may be minimum investments on an investment platform or a minimum monthly contribution. So knowing that kind of thing. Also, there's limits on how much you can put in each account, which we'll talk about. Knowing that sort of thing really helps with where are we going with the money. So here are some places. The first three are places where you can put money. These are the buckets or the accounts where the money can go. And so our first category is our taxable bucket. This usually I see this kind of a bucket used for general wealth building. What is a taxable bucket? Believe it or not, you probably have one, an interest-bearing checking or savings account. When I say taxable, what I mean is you've paid payroll taxes, income taxes, you've paid income taxes on this money. It's gone into an account. Every year you get an interest statement saying, this is how much interest I made on this account. You send that to the IRS when you pay your taxes, and they tax you on it. Many of you probably aren't making any interest right now, or the interest amount is negligible, so it doesn't matter. But if you were to consider having $1 million in a non-qualified or brokerage account, then maybe we're paying some taxes every year. And so that is a taxable type of account. The pro to having money in a taxable account is you can access it for any reason at any time, just like your checking account. If you wanted to go to the mall with it, if you wanted to buy a lake house in South Oklahoma, you could do that. The cons is it's taxed all the time. As opposed to a qualified account, qualified accounts are called that because they have special IRS qualifications, and you can get taxes deferred by making contributions to them. For example, you may have had a 401k before. That's the most commonly known qualified account type. So you make contributions to that account pre-tax before you pay income taxes on it. It grows tax-free inside of that account. I'm doing this with my hand. This is the growth. It's growing tax-free inside of that account. And then when you take the money out, it's taxed. There's a bunch of examples on the screen of different types of qualified accounts, all with different rules. I should mention a Roth IRA or 401k is separate. It's qualified, but it's special. I'll talk about it in a second. But a 401k, a traditional IRA, a SEP IRA, or a solo 401k if you're self-employed, a simple IRA if you're self-employed. Those are all tax-deferred qualified accounts. The exception on here is going to be your Roth IRA. You can contribute to that account after tax, after you've paid your income taxes. It grows tax-free. And then when you take the money out in retirement, it's still tax-free. It's a miracle. Okay, so that's a really fun account you can contribute to depending on your income level and assuming that you're contributing for the purpose of retirement. Yes, there are exceptions, but we're not going to talk about that right now because this is just the 101 level. If you want to talk about exceptions, text me. There's also a few different types of accounts that are tax-free. They're not really tax-free, but for example, there are for specific cases, like a 529 plan works very similarly to a Roth IRA. You put the money in after tax, it grows tax-free, and you have tax-free distributions if you're using the money to fund the college or education of the person who is the beneficiary of the account. So think of it like a Roth IRA, but for college. Similarly, an HSA or a health savings account works like a 529 or Roth, but it's only for medical expenses or healthcare related expenses. So you put, here's the difference. You put money in this account pre-tax out of your paycheck. It grows tax-free, assuming you have enough money in your account that you've been able to invest that money on the platform where your HSA lives. And then you can take money out as a tax-free distribution by swiping your HSA card or going through whatever process they have to make sure, the company has to make sure that you're using it for qualified expenses, healthcare expenses. So there's a couple others on here that are not really what we're set up to talk about today, but they are ways for you to grow your money tax-free and take distributions tax-free, like cash values inside of a life insurance policy, equity in real estate you may own. So those are a couple, those are not 101 level things, but those are things that I would talk to clients about. I wanted to put this on the filling, I call it, what's in the accounts. I wanted to put that on the screen because there's a lot of confusion about just the language that people that aren't in my business use that's really confusing. So to be clear, we're talking about the account types. So your account type could be an IRA or a Roth, but what's in the account might be a mutual fund, an exchange traded fund or ETF, stocks, real estate investment trusts, bonds. Those are what go in those accounts. So sometimes people are like, I want to invest in a Roth IRA. A Roth IRA is an account like a bank account is an account, but what goes in it is different. So a bank account holds cash. Inside of a Roth IRA, you can hold stocks, mutual funds, ETFs, etc. The filling, that part. If you're just getting started, depending on your platform, you're probably going to be using mutual funds or ETFs. I really would love to talk to you individually about what you're doing. But just for now, I'll just give you kind of an overview of what your options might be. So you might have a mutual fund, which is a basket of stocks. Think about the stock market as a grocery store. A portfolio manager may go to the grocery store and pull down all the things that he thinks are cool and could perform well based on your risk tolerance and put them into the basket. And then me and all my friends could say, hey, I'd like to invest in your basket, but I don't have the money to buy all of these different holdings individually. Could I buy a percentage of what you have? And then as the basket increases in value, I can partake in the gains. And if the basket loses in value, I would also be proportionally accepting of the loss. And he, because he's a portfolio manager, would say yes, because that's how mutual funds work. ETFs are similar. I'm not going to get into the details on the differences between those in this call, but ETFs work similarly, baskets of stocks. Individual stocks you can purchase individually. Why wouldn't we all go out and just do that? Because you'd have to build your own portfolio, which takes some expertise because it can be more expensive to trade stocks individually. Sometimes you're paying per trade. Additionally, one stock of something could take up all of your budget. So if you have $100 a month to contribute to your account, you may not be able to buy a share of, Tesla today. And it might take a long time for you to get enough money accumulated to go out and buy one share of Tesla. And also, by the way, once you got the money saved up in your account, you'd only have one share of Tesla, and that's not a very diverse portfolio. So I typically start to implement stocks, individual stocks in portfolios when they're a little bit larger than just getting started. So maybe as low as 250,000, closer to $500,000 might be what I'm looking for before we start to do a stock portfolio. Another thing to consider, a fun thing I like to mention actually, REITs, real estate investment trusts, they are like mutual funds, but with real estate. You do typically have to have $250,000, $500,000 to be able to partake directly in a REIT. But a lot of the mutual funds that you can find have some real estate exposure. So you might have 2, 3, 5% of your money going towards some sort of real estate investment as part of a mutual fund. And then finally, bonds. Bonds are the safety instrument in your portfolio. Safety. Bonds can go up and down in value, but they're considered, because they're a debt, a bond is me saying, hey, Coca-Cola, I will loan you $1,000 and you will pay me a percentage in interest, a coupon rate, as an owner of this bond. And when the time is up and you owe me the money back, you're going to pay it back. And so we're talking about, in this case, high quality bonds with companies that you know are likely to pay the money back. That's considered a safety or a balance to your portfolio, as opposed to a stock, which is ownership in a company. The values go up and down a little bit more. So you must know that as a financial planner, I would really prefer you work with a professional. But if you're just getting started and you're in a DIY mode, I would say a mutual fund or an ETF is likely, an index fund is likely going to be what you'll encounter in the retail space. Hi, y'all. I'm back in a different outfit because I couldn't sleep this weekend, because I was thinking that you might want to know the difference between an index fund, a mutual fund, and ETFs as you're starting your trading journey. So this is very complicated and I didn't want to do this here, but I feel like you need to know. So I'm going to try it. And then if you have questions, let me know. So generally speaking, we talked about mutual funds in the last slide, which was the illustration I gave of a portfolio manager rolling through the grocery store, taking investments off the shelf and putting them in the basket. So a mutual fund is a basket of stocks. Mutual fund companies offer a lot of different funds based on your risk tolerance and your goals. Index funds are like that, except they're based on an indices. So the index that you're likely the most familiar with is the S&P 500. So the top 500 largest companies in the US stock market, there is an index that we use to follow those stocks, and your index fund will be made up of stocks similar to or the exact same as the S&P 500, so that you're keeping pace with the market. That said, an index fund that's just based on an S&P 500 or the Russell 2000 or whatever it is may not give you the amount of diversity that you want. So it may be just equities and no bonds or no fixed instruments or no what we call safety instruments. So you probably want, or you might find that an index fund is also in a mutual fund. Yes. So you may have a mutual fund that's part S&P 500 with some fixed income or bonds in it. So basically think of an index fund as, which the most common one that people think of is, I just want to do whatever the stock market's doing. Do that. That's one thing. A mutual fund is a selected basket of stocks where a portfolio manager picks. It may be stuff from the S&P 500. It might be smaller companies. It might be international companies. It might be debt to companies. So you get a little bit more diversity. And then exchange traded funds came along relatively recently. The main difference between ETFs and mutual funds is they trade like stocks. So a mutual fund or an index fund, if you decide, hey, it's 1:00 on Monday, I don't want to have this mutual fund or this index fund anymore, and I want to go to sell it, you have to wait till the end of the trading day. And if it's a crazy trading day, you might decide at 1:00 at one price per share, and it might be a totally different one by the end of the day. With an ETF, you can trade it the way you would trade an individual stock of Tesla, an individual stock of Apple or of Alphabet. So it gives people a little bit more flexibility in how they trade. People say too that some of the expenses are lower with ETFs. You have to kind of judge by platform and by mutual fund or ETF. But I just wanted to give you just a high level, the difference between all these things. What I'd recommend you do, especially if you're in the phase where you're just ramping up just to get to 100,000, is pick a strategy that's diversified and just, again, invest month after month, dollar cost average into that fund with the amount of risk that you're willing to take on, and just slowly grow your money. That's what this game is all about. It's doing the boring, rudimentary stuff just to grow your money to get where you want to be. All right, back to regular scheduled programming. So now you know a lot about what buckets exist And maybe if they're pre-tax with a tax-free distribution, or they're after tax with a taxable distribution, you're an expert by now, of course. But you might be wondering which account is right for me. So I borrowed this lovely graphic from the College Investor, and it basically shows where you might want to start in terms of investing and then where you might want to go after that, sort of the path of where money should go. And so the number one place that you might consider putting money is if you get a match in your 401k. The 100% return on investment on your match to your 401k is an excellent place to start. So contributing up to the match. And then you may want to consider, depending on your situation, you might want to consider a Roth IRA next. So there's a limit to how much income you can make and still contribute the full $6,000 a year to a Roth IRA. Sometimes, depending on how much you make, you can't contribute to a Roth IRA directly at all. The question I'm asked sometimes is on this flow chart, why would you contribute up to the match and then go off of that investment company's platform and start a Roth IRA or a traditional IRA and then go back to max out your 401k? The reason I see people do this is because maybe the quality of the investments or the strategies that they want to invest in aren't available on their company's 401k platform. Remember, a 401k is a benefit of working for a company, and so that company makes the decisions on what investment company manages the 401k and what investments you have access to on the platform. So definitely do the 401k to get the match, and then maybe consider, am I happy with the investment options on this platform? If so, max out the 401k. If there's a Roth 401k option, excellent. But otherwise, I'd say 401k to get the match. If you're doing any additional, maybe consider something like a Roth IRA or traditional IRA, and then go back and top off the max 401k. Terminology I hear all the time is I'm maxing out my 401k. And I always ask, are you doing the max to get your match, or are you doing the IRS maximum? So the IRS allows you to do $20,500 in contributions to your 401k as of 2020. It changes every couple of years or so. If you're not doing $20,500 and you're under 50, then you're not maxing out your 401k. The next step, another place I'd consider, is your HSA, which we talked about. It's for healthcare expenses, but if you can accumulate usually over $2,000, then you are allowed to invest on their platform. Typically, I say platform because sometimes these are usually sponsored by banks, but they're a part of your benefits at work. So everyone's is different. See your HR with questions about that, or if you're a client, come to me and we will figure it out. Another place that you would consider is a SEP IRA. A SEP IRA is an IRA type for self-employed people. So in this example, he says, have a side hustle and contribute to your SEP IRA. But if you don't want a side hustle, that's okay. If you just are an entrepreneur, a SEP IRA is great, a great place to start. It would replace your contributions to your traditional IRA. How they're different is a SEP IRA allows you to contribute more than just the $6,000 limit that a traditional IRA does. So traditional IRA, $6,000 limit. SEP IRA, it is 25% of your income. I think it's up to $54,000 max. So let's just say you make $100,000, you're able to put $25,000 into your SEP IRA as a contribution savings for retirement versus a traditional IRA where you can only do $6,000. So that's the benefit there. Standard brokerage account is the account type we talked about that was taxable. So just like your bank account, but it's set up specifically for investments. Notice that it's pretty far down the line. The standard brokerage account or taxable accounts, that's where you really implement those cool strategies like, I won't give you any because I don't want to get in trouble. But in a lot of cases, app-based platforms, those are non-qualified, just fund trading accounts. And so most of the time, you're not getting any tax benefits. You're just trading and growing your portfolio. Those are great places to save for midterm goals, things that are not happening immediately, like not in the next 3 years, but maybe between now and retirement in that middle section of life. That's a great place to save for those because it's flexible how you take it out. But again, taxable all the time. Important question, and one that requires answering. Should you DIY your investments or delegate? So I love what I do. I love talking to people about their investments, but it doesn't always make sense for me to work with everyone. And I get that. On my platform, the minimum to invest is $10,000, but if I ask nicely, we can usually get an exception down to $1,000. That said, unless it's a client I work with on other things, on their holistic planning and everything else, it doesn't always make sense for you to jump right onto a platform with a financial advisor. So I would say if you're doing your financial planning on your own, I would definitely just get started, maybe with a high quality mutual fund or index fund, just to build up to $50,000. Just set up an automatic investment plan to go to an investment account. Make sure it's actually invested in something. We're going to talk about risk tolerance soon. But one thing I notice when clients manage assets on their own and then they bring them to me later, sometimes they're not invested in anything. Just because you put it in the IRA doesn't mean anything's happening. You have to choose an investment. So that's the benefit of having a human involved. So again, you can start with a financial advisor. With me specifically, you can start with $1,000 and go up from there. Every financial advisor kind of has their own rules about it. I would say once you've got about $100,000, we're maybe considering the efficiency or tax efficiency in your accounts. Again, the taxable accounts, this matters. The tax deferred accounts, it doesn't matter that much. The object of the game there is just to grow them. But considering your tax status of the account, also we're thinking about diversifying once you get to that point a little bit more closely. So are we adding multiple strategists or managers in your account versus just one mutual fund before? So that's something your advisor can help you with based on your goals and your tolerance for cost and risk. But at $100,000, I might consider putting multiple strategists in one account. Most of my client accounts have 3 strategists in them, unless they're under like 50,000 or so. And then finally, if you're over $500,000, a world of things opens up to you that's really cool. So usually 250 to 500 is when I start talking to clients about alternative investments, which are fund REITs specifically, which we talked about again. Maybe considering hiring a specific portfolio manager that they talk to on a quarterly or annual basis about their portfolio. Typically that's over $1 million, but if you're super interested, maybe we can do it at $500,000. And then when you're in retirement, especially if you're over $1 million, it's likely that we are executing several strategies sort of in silos or sleeves rather, within one account. So you might have an IRA that has a sleeve that's more conservative because we plan to use that money sooner, another sleeve that's a little bit more moderate in its risk allocation, kind of medium risk. Then you might have a sleeve that's more aggressive because that's money earmarked for you 20 years down the line in retirement or maybe for legacy planning. So as you have more, there's a little bit more complexity, and just important to know that wherever you are, get started, take action, ask me if you need help. It's time to talk risk. So part of the equation in figuring out how to invest is determining your risk tolerance. This is a screenshot from a questionnaire that I use that helps me to determine how comfortable you are with risk. One of the most important factors is what your time horizon is. Your time horizon is how long between now and when you want to use this money do we have to invest it. Typically, if your time horizon is less than 3 years, I want to tell you to put the money in the bank. So if you said, hey, I want to buy a house in 2 years, we're saving up for that, how should we invest it? I would say don't invest it, put it in your bank account. Because the goal of that money is just to be there and you can't afford to lose it. Sometimes the stock market, when it goes down, it takes a couple years to recover. And we don't have time for that because you need the money for your home purchase or an emergency fund, for example. do not invest your emergency fund. Its job is to be there if you need it. That said, if your time horizon is 20 years from now, you can afford to take a lot of risk because you will probably see 1 to 2 full cycles, ups and downs in the market. And if something happens between now and then, you'll have time to correct it. The market will have time to correct. You can change your strategy once the market recovers. You've got time to make it up. So your time horizon is important, but then also just how comfortable are you stomaching risk? If you looked at a hypothetical portfolio, for example, and you invested $10,000 and you had the chance to gain $2,559, but you had to expect the risk that you could lose nearly $1,600 and you would lose sleep. If you got a statement that said you lost $1,600 of your $10,000 invested, then that's just too risky for you. So part of a risk tolerance questionnaire, if you found one online, or I have a PDF version of this, I could email you. Part of that is figuring out just what can you stomach as a human. The last thing is sometimes people take on too much risk necessarily. So a part of financial planning is I will look at what you have, what you need to retire, let's say, as an example, and figure out what that gap is. And we may find that you could have this middle risk tolerance and that expected rate of return is high enough to get you where you want to go without you having to do the highest level of risk to get there. I hope that makes sense. I'm going to talk about this a little bit more on the next slide. So here are a couple of the model portfolios that I personally use with my clients. You'll notice the one I have highlighted up front is the HerPlanning 5 growth. So on a scale of 1 being conservative and 6 being the maximum aggressive that I will allow, I pretty much allow you to be in my models. 5 is pretty aggressive, but not quite at the edge. And so this is I brought this one up to the forefront because this is the most commonly used in my practice. Many of my clients are approaching, but not at retirement. And so I use this one quite a bit. Their clients are still in the accumulation phase. If you were in retirement, again, a couple of these might make sense for different sleeves of your portfolio. Let's have a conversation offline about that. But for example, in the HerPlanning 5 growth portfolio, you'll notice that 88% of this portfolio is made up of equities. So we're looking at the things that would help us grow our portfolio, the growth instruments. And then the balance of the account is 3% in cash and the rest in what we consider safety instruments. So we talked about debt, bonds, international high quality bonds. That's what this looks like here. You'll notice the conservative one in the background is we're not trying to take on too much risk there because our goal is just to mostly conserve our money and get a little bit of growth. So the annual return on that portfolio is 5.9%, pretty high for a conservative portfolio, but we've had historically high returns in the market in the past few years. But the equities portion is only 17%. So 17% of this portfolio is slated towards getting you growth and 83% is just slated towards more income or stability in your portfolio. So figuring out, again, your time horizon, how long do you have before you're going to need to access the money, what your goal is it retirement, is it emergency, and then what's your risk? Those are the top 3 things to consider when starting to build your portfolio or selecting your investments. As we wrap up, I want to give you a couple of my do's and don'ts, the rules to investing, and questions I get asked a lot this week and this last month is, should I stop investing, change, or should I get started in a down market? And so I'll answer that with my rules. So pick a platform and get started. I'd love to work with you. Reach out to me about how to make that happen or text rollover to 619-333-5418. So you can get started on your own if you do that route, or reach out to me and I can help you with it. Pick a strategy and stick to it. So whenever my clients say, should we make any changes because the market's down? Doesn't happen very often, but when they do say this, I ask them if the goal has changed. So has their goal changed, or did they find out their risk tolerance is really not their risk tolerance? If their goal is closer than last time we talked and significantly so, then maybe we want to make a change. But if their goal has not changed, if we knew the stock market was going to go down, it does that. We know it'll go back up. That's what it does. Do we have enough time to get there is the question that I help you answer with planning. But if don't change your strategy if your goal or the purpose for the money has not changed. Dollar cost averaging we talked about. Another question I get asked is now a good time because the market's down? I'm going to say it like a realtor who says it's always a good time to buy real estate. So what we know from a research standpoint, well-researched, is that you take advantage of the highs and the lows in the market if you just do what's called dollar cost averaging, put money in consistently over time, and don't try to time the market. We find that the 10 highest days in the market tend to be really close to some of the lowest days in the market. So if you jump out when it's low, and then you try to jump back in, you try to figure out when it's going up, you're usually going to miss the going up part if you jump out when it's low. Also, everything else you buy, you don't buy this way. When dresses are on sale, you buy more dresses. You don't sell dresses because they're on sale. So think of the stock market like buying clothes. When things are on sale, you buy them, or you just buy them consistently because the seasons are changing. I know you didn't think a financial planner would know things about buying clothing, but guess what? I like to shop. Okay, sidebar. So consider your overall risk tolerance in your current profile. Do that. And also consider using a pro, especially if you've accumulated over $250,000. Even if it's not me, consider using a professional at that point. Do not try to pick individual stocks or currencies when you're just starting out. You know the currency I'm talking about. It's not an asset class. It's a religion. Don't go jumping on stuff you read about on the internet if you don't have an emergency fund or your debt paid off. Don't jump from one hot thing to the next. Stay with the same strategy unless your goal has changed. Don't try to time the market. Don't start investing if you've got high interest debt. And don't hesitate to reach out if you forget all these rules or you need help. I'm always glad to answer the little questions. Finally, my favorite piece of advice is to take action. Sometimes people ask me, because my company is targeted to working with women, why women are different than men as investors. Investment companies love working with women because secretly, women tend to be more buy and hold or consistent investors. So they tend to pick a strategy and stick with it, which investment companies love. Give them time to do the thing that they do. They love that. The other thing is women tend to need more information before they're willing to take action than men do. So those are the two kind of main areas where I find that men and women are different when it comes to this sort of thing. I am going to challenge you to take a step, even if it's not moving all of your money onto a platform or over to me, anything like that. Reach out to me with a question via the text number below, or text software to 619-333-5418. I will send you a link to Right Capital, which is the financial planning tool that I use with my clients. It's very similar to if you've used Mint.com before. Aggregates all your assets. You can see them in one place, track your net worth, and just sort of get started and get a good understanding of what your cash flow is like, what your liquidity or emergency fund goal should be. So Right Capital can help with any of that. And then you're welcome to set up a complimentary 30 minutes with me for me to check it out with you and give you the lay of the land. If you have a rollover, or if you have an investment account that you'd like to start or transfer over for me to help you manage, you can, or also if you wanted to go through the process to get your risk profile, you can text rollover to me at that number below, and I'll send you the link for you to get started there. Finally, I would love to connect with you in some other way. I am located in Bixby, Oklahoma. Odds are you don't know where that is, but if you do, come by the chamber and say hi. Otherwise, you're welcome to text. I am a real person on the other end of the texting. Occasionally, it could be a staff or compliance person, but it's usually me. You can email me, Kristin@HerPlanning.com. Check out my Facebook my LinkedIn, HerPlanning's LinkedIn, and then on YouTube, we're posting some content as well. If you have questions, concerns, ideas for other content you'd love to see, I'd love to hear it. Otherwise, I hope that this helps you be great with money. Bye, y'all.